Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
One thing we have to consider when we're looking to implement this kind of strategy is that what you're really saying to the market is, I really don't know which way you're going to go. I want to have it both ways, so I'm going to pay a little bit more to do that. Anytime you elect to take on that mentality, and anytime that's your objective, you have to understand that your profitability on that transaction is going to be less than if you had simply picked a direction and you were correct on it. So you have to understand that we sacrifice some profitability because we're actually trying to play both sides of the trade. The other way that this can be managed, of course, guys, is if we look at a possible target up onto the upside around 107, and we believe that within the time frame that it's going to hit 107, and we believe that it may actually turn around and reject off of that level, what we can do is we can sell those call options up in here for a profit, hold on to the puts, and then ultimately generate some of our premium back on the put options as the pair begins to retrace back that move back. So there are a number of different ways that we can actually manage this, but ultimately you can see based on what we're looking at here is if you choose to hold that position until expiration, you would need a very significant move in the pair value in order to compensate for the cost of that of the premium. Now, you can see here, once again, just to review how we constructed this particular position, we're going to buy one CD October 105, CDD 105 call. It's going to cost us $1.92. That's $192 per contract. We're going to also buy one October CDD 105 put. That's going to cost us $1.64 or $164 per contract. Now, if we look at the profit and loss on this transaction, you can see that the maximum risk exposure is if the pair is actually trading at 105 between now and expiration. Your break-even point on the downside is the 101.44, and as it begins to trade below those levels, of course, these levels down in here might be a little out of range at this stage, but recognize that as it begins to trade below that, as it closes anywhere below 101.44, we recognize a profit. Similarly to the upside, anywhere above 110 on expiration, 110.03, 108.56 on expiration reflects a profit beyond that. So, guys, this strategy is not necessarily meant to be a home run unless you're managing it a little more proactively throughout the life cycle of the trade. If you're simply looking to take advantage of a direction, but you're not sure which it's going to go, and you are just looking at holding the position in its entirety right until expiration, you have to recognize that you're going to suffer on the profit side a little bit, simply because you have to compensate for the opposite side of the trade that you've had to purchase. So, another alternative to taking advantage of this particular opportunity would be to establish what's known as a strangle. And a strangle, once again, we're buying a call and we're buying a put option. We're looking at, once again, the same pair value, same expiration, although, as I mentioned, we can vary that dependent upon our particular bias. But we're selecting different strikes. So, of course, the term strangle comes in from the fact that we are, in fact, surrounding a particular pair value with the strike prices. So we're, in fact, strangling the immediate price of the pair value using different option contracts. Now, in this example, we'd be looking at the CDD trading at 105, and we expect the pair to be volatile, but we're simply looking to create a little bit a less expensive position for ourselves. So we could look at the 2-month 106 call, and you can see that that's asking $1.61. The 2-month 104 put is asking $1. So the actual cost of this transaction is determined by adding the $1.61 for the 106 calls to the dollar premium that we're required to pay for the 104 puts. We have a net cost of $2.61, and ultimately that reflects our maximum risk exposure. So when we take a look at trying to determine the upside break-even points on this particular transaction, we simply take the strike price of the call option and we add the entire cost of the trade. So in this case, it's $2.61, and we determine that on expiration, the pair value needs to be trading above 108.61 for us to make a profit. And on the downside, we simply subtract that the net cost of the strangle from the 104 strike, and we see that it needs to be trading below 101.39 on expiration for us to make a profit on a downside move. Now, if we take a look at at the chart here and what we may expect to take place with respect to the pair value over a certain period of time, you can see that essentially we have our break-even points. Now, the break-even points of the trade are not so much any more attractive than what they were with the straddle, but the fact is we have actually lowered our risk exposure almost by $1. Now, the other thing that that creating a strangle allows us to do is it allows us to participate if we happen to have a directional bias. So let's say, for example, over the last over the next couple of months, we have a directional bias to the upside. We might be more inclined to buy an at-the-money call option, pay a little bit more money, looking to capitalize on an increase in intrinsic value moving forward, and we might just for insurance purposes go out and buy that the 103 strike put option just to offset some of the risk should the pair value in fact roll over and start going against us. So there are ways that we can actually manipulate the strike price selection of a strangle in order to reflect a particular directional bias. Now, the other idea is that we can also make that sort of manipulation with the number of contracts that we purchase, and we can also do that with respect to the number of or to the expiration cycles that we choose. So when you think about implementing a straddle or a strangle to take part in a particular move in a pair value, understand that you're not just simply chained to the idea of it having to be the exact same expiration month or the exact same strike prices. You can actually manipulate the expiration and strike selections in order to accommodate a particular directional bias. It still is implementing the same rationale as we're discussing here, simply using a simple strangle or a simple straddle to participate in these particular moves. So the main consideration would be if you have no clue, if you have no particular directional bias whatsoever, you could stick with a typical straddle or a typical strangle that we're referencing, but what you can do if you happen to have some sort of an inclination or directional bias, you can start manipulating the expirations dates as well as the strike prices in order to accommodate your directional view.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.